on how does that look? How do they raise capital? Does it cost them more money? Is that going to take away from their profits? If it does, then we have to adjust our profit expectations going forward for them. So you can see how these things are all kind of connected. Now, that doesn't mean to say everything's consistent in this narrative world, right? So one of the things that we look at, of course, is the yield curve. And one of the great kind of nice predictors of recessions is when the yield curve goes negative, right? This is pretty well known out there. As a matter of fact, the Federal Reserve Board and the San Francisco Federal Reserve have both written papers on this recently. They're worth reading if you get a chance. What this slide shows is the 10-year interest rate on U.S. government securities minus the 2-year interest rate on government securities in the United States. This has a really nice track record that when that number turns negative, you get a recession. And that's in the gray area. So you can see it's got a leading indicator. It's kind of like 12 to 18 months prior to the recession. If that goes negative, then you can start to anticipate a recession coming forward. And so we're down around 19 basis points, which is pretty low. We popped up to about 30. Now we're coming back the other way. So we watch this really closely, and you'll start to hear that narrative come forward about fear of a recession as that yield curve flattens, as the Fed pushes up short-term rates and the long-term rates don't go anywhere. It's basically, I don't know if you've done much studying on the yield curve, I can send you information on it, but basically what it is just saying, look, the market expects a much slower growth in the future, and that's why longer-term rates are lower than short-term rates. Bottom line. So they're anticipating cheaper funding rates out in the future because they're expecting a recession. That's kind of the theory behind it. But this is kind of fun to pull up and just to keep an eye on. So this is, again, adding to the uncertainty that's going out there. All right, so let's shift gears a little bit. Let's talk about U.S. domestic policy, because it's impacting everything that goes on from this point of view. Now, I want to tell you, I'm not advocating any policy position here, right? That's not my role. It's not the CFTC's role. Our role is just to try to figure out what the market's anticipating. How is this being reflected in market values? And it shows up in a lot of different places. So I want to show you 3 spots where this shows up that you can kind of keep an eye on really quickly. It shows up in a lot of different areas, and I think everybody's kind of familiar with it overall. But let me just show you what I'm talking about. So this is the Earth. This is a little different gravitational pull for the markets, right? So these things have a tendency to not be as strong of an influence as the sun or monetary policy overall, but they're still really, really important, especially to specific countries. So with that in mind, I think you know where I'm going with this. So let's talk about the NAFTA negotiations. Obviously, this is this trade agreement between the United States, Canada, and Mexico. Up on the slide is the US dollar versus the Mexican peso. And it's a really clear example of how the markets were voting with their feet when they believed that NAFTA was not going to be renegotiated or we weren't going to get a trade agreement between those 3 countries. So the dollar rallied significantly towards the middle of the summer. That's the big spike that you see on the graph. Right before we started to get some breakthroughs between the United States and Mexico on a trade agreement. And then it tumbled the other way. Now, since that time, we've seen it somewhat stabilize. But this is a great harbinger or canary in the coal mine or whatever you want to call it, indicator for how those negotiations went. And so I just, it's a real simple one. Now, oops, let me go back one. This thing's sensitive when it wants to be and not sensitive. There we go. So when we're talking about the tariff situation and the trade discussions between the United States and China, I like to use the Australian dollar as my indicator. Now, my background is in currencies, and I will tell you the currencies react so much more strongly than other markets, and they do it right away. They don't wait around. So they're really good to keep an eye on. If you get up every morning and you want to know what's going on in the world, if anything's happening in the financial markets, don't look at stocks, don't look at bonds, look at the currency markets. And if you see something that's moved 1%, you should sit up and take notice. Because when currencies move, they have a tendency to really indicate that something is happening in that space. And a 1% move in currencies is a big move. It's the biggest, baddest market out there. I forget how many trillions of dollars a day it gets traded. I think it's over 5 trillion right now. So it dwarfs all of the markets. Australian dollar. At the beginning of the year, it put it in its highs for the year, right? That peak is in January. And what happened in January? The United States imposed steel tariffs, and I think tariffs on, I want to say refrigerators or washer and dryers, those kind of things, durable goods coming into the country, specifically, I believe, on China. And so you can see what happened with the Australian dollar. And as the year has progressed, this has gone on and on and on. There have been rounds and rounds between the two nations of throwing on tariffs on each other. You can see what's happened. The reason why we like to use the Australian dollar is because obviously so many exports from Australia in commodities go to China and have. That country has benefited significantly from the growth in China, as many countries have, including the United States. But the infrastructure build-out has really aided Australia's exports as they export a lot of raw materials that go into infrastructure build-out, right? This is a wonderful example of what happens and the values that the markets adjust to really quickly. So if you're wondering how those negotiations are going and you haven't read any headlines, just take a look at what's going on in the Australian dollar. Now, I will say this is not the only thing that's going on that's influencing the value of the Australian dollar as far as the trade goes and the trade negotiations. Clearly, China's slowing their economy or has slowed their economy. This is part of the deleveraging program that the Chinese embarked upon to squeeze out some of that leverage that had built up over the years, especially since 2009. But this is part of the story, right? So it's something that I think it's just a nice tool for you to use, something for you to keep an eye on. And lastly, obviously, we've got a big event coming up. We talked about energy, right? And this event has been out there for some time. Everybody's kind of known about it. It is the sanctions that are going to hit Iran at the beginning of November, on November 4th. And this is a price graph of Brent crude, not West Texas Intermediate, but Brent, because most of the Middle East oil is based off of Brent pricing. And you can see what's been going on. The price of oil has gone up. It's part of the overall situation with the oil markets. As a matter of fact, I was just down in Dallas at the Dallas Federal Reserve Energy Conference. They put that on with the Kansas City Federal Reserve and the Dallas Federal Reserve. It's an excellent conference. If you ever get a chance to attend it, you want to know what's happening in the energy space, it's a great place to be. At that conference, there were 2 words I constantly heard from the participants. One is a fragile equilibrium, and the second one is volatility. Both have played out extraordinarily well. If we're in a fragile equilibrium in the oil market where you have supply at 100 million barrels per day and demand at 100 million barrels per day, right? It's very fragile, right? It's very tight. If you take Iranian oil off the market, you can lose somewhere between, I don't know, 1 million to 1.5 million barrels per day, right? And if you add that on to, say, the declining oil production in Venezuela, which we've lost about another 1 million barrels per day since, I want to say, 2015-ish, right? All of a sudden, we're starting to see some things that could disrupt the oil market. And I think it's one of the reasons why that oil had rallied this year, even though we weren't seeing the global growth story be as strong as it had been. Definitely in the United States, but clearly China is one of the biggest drivers of oil prices. Their demand for energy has been super important. They've obviously been slowing. So I'm kind of been surprised that oil